A little disclaimer here. Please note that this material has been prepared for information purposes only. It is and is not intended to provide or should not be relied on for tax or tax, legal, or accounting advice.
Good afternoon. I'm California State Treasurer Fiona Ma, and I would like to welcome you to this CalABLE webinar. As State Treasurer, I believe that CalABLE is an excellent financial tool for Californians with disabilities. For the first time, eligible individuals on means-tested benefit programs can save up to $100,000 without having their benefits impacted. CalABLE is a game changer, providing people with disabilities a low-cost, tax-advantaged way to save and invest for a better financial future. I am committed to promoting this program and for doing all that I can to continue to help people with disabilities strengthen their financial position to achieve a better life experience. Thank you for joining us today and for your continued support of the CalABLE program. I will turn things over to the CalABLE team to begin today's webinar.
Thank you, Treasurer Ma. I am Ann Osborne, the Deputy Executive Director here at CalABLE. I am a female with brown hair, and I wear glasses, and I'm also wearing a green shirt. As we begin our topic, financial planning with CalABLE, we really are excited that everyone's here today. In the chat is a link to our webinar slides. If you are joining us late, please look at the chat and you will be able to find the slides on our website. Next slide, please. Before we begin our presentation, we always like to find out who's in the audience. So we're going to have a poll here. The first questions will be, are you an account holder? Are you authorized legal representative, a parent, a state employee, a service provider, a potential CalABLE participant, or other? And we'll give a few minutes here to answer this. Okay, thank you, Vivi. So looks like most of you are authorized legal representatives or parents. The next highest group here is account holders, and then we have some service providers and others. Looks like we have a good mix of people. We'll go to our next poll. This is what we'd like to know is that have you attended a Cal webinar before? Yes or no? Oh, wow. We've got a great attendance today. 65% of you have attended previous. So thank you for coming back. I hope you find this useful to you. And 35% of you have never attended. So welcome to your first CalABLE webinar. We've got one more poll question. And this is because we are talking about financial planning, serving. So what are you saving? You know, how are you using your account? Is it going to be for long-term savings, retirement, medium-term savings like a house or a car, day-to-day expenses like bills, groceries, or are you using it possibly for emergencies, or you're not sure, or it doesn't apply to you? Wow, Jessie, I think we got our work cut out for us today. 40% are looking at it for long-term savings. Next one is day-to-day expenses. And then medium term, and emergencies are kind of towards the bottom. So good group of people. We got a lot of interest here. We have a lot of diversity as far as how we're going to be using our accounts today. We'll go to the next slide. So as always, we do like to just touch on the CalABLE basics. I know several of you have been to this CalABLE webinar before, but just a quick reminder of how these accounts work. First thing is CalABLE is a tax advantage savings and investment program designed to help people with disabilities achieve their financial dreams. And that's truly what we are here to do. And that's why we have this webinar today about finances. And so really happy that we're able to talk about this topic. Really a topic that we've been hearing a lot from, especially account holders. So I'm happy to see that we have a lot of you here today. We'll go to the next slide. Again, the contributions this year for 2025, the cap is $19,000. That's January through December. So you still have time to put money into your account. If you as your account continues to grow over time, once you reach $100,000, if you are receiving SSI benefits currently, you would need to do a spend down if you want to continue your benefits. If you continue to grow your account, you put up to $529,000. This is for somebody who is not on SSI. Then you can contribute up to $529,000. Again, both of these accounts will continue to grow in earnings, but those are your magic numbers, 19,000 this year, January through December. If you're on SSI, you can save up to 100,000. And if you're not on SSI, you can save up to, you can make contributions up to 529,000. We'll go to the next slide. Able to work is another way that you can contribute to these accounts. If you're working and your employer does not have a retirement plan for you, you can actually save up to $15,060. Again, if you were to combine both of those amounts, your annual savings of 19,000 with the 15,000, you could potentially save up to $34,000 in 2025. So some great opportunities for people that are out there working. Next slide, please. So we're going to hear more from Beswell today, but really we do have different portfolios. We have 8 different portfolios. These have the potential to grow tax-free. And if you keep them in your account, they can grow over time. And Jesse's going to be talking more about this in his presentation. I will just mention that these portfolios are managed by Fidelity, Charles Schwab, and Vanguard. So we'll go to the next slide. And this is a really helpful slide for all of us. We like to know what you're saving for. Is it a first home, your accessible vehicle, education, technology, service dog, health and wellness, recreation and vacation, and other. Okay, some great results here. Oh, health and wellness, that is the top one. Recreation and vacation, that comes in second place. And first home, education. Other, I'm not sure, that's a large percentage for others. So maybe those are our longtime savers that are doing the other. But thank you for those results. And we'll go to our next slide. How can I spend my money, or what can you spend it on? This is always a big question we always get. And it's very simple. As long as that expense is related to your health, your independence, or quality of life, you can use your account. Doesn't have to be all these. If you answer just once to the question, to one of these things, it's allowable. So education, we saw quite a few people saving for their education. That's books, tuition, if you need a tutor, anything that you would need to help you with your education, certainly allowable. If your transportation costs, you're using rideshare, public transportation, anything that you need to get to wherever you're going, that is also allowable. Food is another thing that you can use your CalABLE account for. We saw a lot of recreation and entertainment. That is definitely allowable. Again, if you can answer the question, does that expense improve your health, independence, or quality of life? It is allowable. We do have one item here which is housing, and this only applies to somebody that is receiving SSI. If you're on SSDI, the housing does not apply to you. But the way this works is if you use anything related to housing expenses, it could be your rent, your utility, it could be paying rent or insurance, whatever you would spend every month on housing related expenses, you need to make sure that you withdraw the money at the beginning of the month and spend it by the end of the month. So if your utility bill is due on the 15th of the month, you'll want to withdraw that money at the beginning and make sure you spend it at the end. Again, this is only for people that are on SSI. This housing expense needs to be spent in the month. If you're not receiving SSI, this does not apply to you. We'll go to the next slide. If you are new to CalABLE, I know we have some people here that are our first-time attendees. To get onto our website, you would go to calable.ca.gov. And if you want to open an account, you would go to open an account, that little yellow button that's on our website. We'll go to the next slide. Next is Jessie Nix, and he is here to talk to us about some financial planning. I just want to reiterate our disclaimer again that this information has been prepared for informational purposes only and is not intended to provide or should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Also, if you're just joined us, the slides are on our website, and we have that link in the chat. So if you want to find the slides, you can find them there. And Jessie is here. Thank you, Jessie, for joining us. Do you want to put that in slideshow? There you go. All right, take it away, Jessie.
All right, thanks so much, Anne. My name is Jessie Nix. I am a white male with brown hair, and I'm a certified financial planner professional, so a CFP. And I work at Nix Wealth Management, which is a small independent investment advisory firm that was started by my father a little over 30 years ago, and we help individuals and families with portfolio management and financial planning. So yeah, thank you again for to CalABLE for having me today, and thank you all for sharing your goals in the poll. That was really interesting to see, and I hope that what I'll be sharing with you today will be helpful in helping you realize all of those goals. So the focus of what I'll talk about today is understanding your investment options and specifically the risks and that accompany those, and maybe help give an understanding of when it's appropriate to have one option over another. So what I wanted to start with today was kind of just a simple explanation of the particles that make up the options that are given to you with CalABLE, right? So there's stock funds and bond funds. And so I'm going to go just with a simple definition of the many little particles within those funds. They're all either stocks or bonds, right? So on the stock side, you're the owner of a corporation. And so you have when you buy a fund, when you select your investment option with CalABLE and it has stocks in it, you are becoming the owner of a small portion of public corporations, right? Whether they be in the US, there's also options, foreign, emerging markets, developed markets, but corporations across the globe, right? So what exactly does this mean? Well, you are now represented by a board of directors, right? And that board of directors represents your interests. And what they're after, since you're the owner of a corporation, is increasing, or they want the companies to show increased cash flow over time, right? They want to show growth in profits, right? So a corporation is worth the amount of cash flow it produces in the future in the coming 5 to 10 years. And this is whether we're talking about a big corporation, Apple, or even just a local restaurant that's not a publicly traded corporation. When you're going to purchase a corporation, what you are interested in is the amount of profits it can produce in the future, right? That's what's going to determine the value of that business to you, the prospective owner of it, is how much profit they will have in the future, right? So the current price for these stocks reflects the expectations of the cash flow that these stocks or these corporations will produce in the future, right? And so that's why stocks can be so volatile. Their current market price is based on future expectations, and those expectations can change for a variety of reasons, which we will cover in more depth as we get through this. And then finally, over to the other portion of the investment options that are available to you, individual bonds, right? So these big funds of thousands and thousands of bonds um, are available to you, but on the particle level, down to what they are specifically, you are purchasing the debt of either, in the case of what's available at CalABLE, either governments or corporations, right? You are the lender, and um, there's a stated price that you pay that you pay, and they're borrowing that money from you, and they pay you an interest rate. Every 6 months, you get what's called a coupon payment, right? And so every 6 months, you make interest all the way up until the stated maturity date of that bond, which often is years away. And then you receive your money back, and having collected interest every 6 months all along the way, right? So less risky than stocks, because as long as these government entities or corporations are solvent, as long as they haven't gone bankrupt, they're still around, you get your money back plus all of the interest along the way. But one thing to note with bonds, and this is especially important because with CalABLE, you have access to bond funds. There's a secondary market for bonds. So existing bonds, ones, let's say, that were issued by a corporation 5 or 10 years ago, can be bought and sold prior to maturing. And this plays into the risks that are associated with bonds, which again, I'll get into a little bit more later. So thanks for sticking with me on the definitions. Hopefully, this will get a little more interesting as we talk about the risks associated with these and why it may or may not be worth taking on these risks to achieve your goals. So on the screen is a graph showing 30 years of performance of different types of stocks and bonds, and the growth of $10,000 over that 30-year period, right? And so there's a lot of squiggling lines here, but the idea is to show what sort of relationship taking on the risk has to your potential for long-term returns, right? So over this 30-year period, you can see $10,000 invested in smaller public companies grew to over $200,000, versus large public companies, large stocks grew to 182,000. So really nice growth from stocks over this 30-year period that's presented. But you can see larger stocks produced a bit less of a return over the long term than smaller stocks. And that's because they are generally, as a group in aggregate, less risky, tend to be more mature companies with more stable and predictable earnings. And a lot of the really large growth in their profits often, as far as expressed as a percentage, often happened earlier on when they were smaller companies, right? So more stable, less risky than small cap stocks, cap meaning the size of the company, the market size of the company in total. And then smaller companies, of course, you got a better return because you are taking on more volatility. The companies are less mature, their earnings are less predictable, right? And so you can see how that played out over 30 years. Moving down the risk spectrum down to bonds, which we talked about, T-bills, those are short-term U.S. government bonds, 1 year or less to maturity. And they're considered to carry zero risk. That's the purple line. It's kind of obscured there with the green line, but the purple line, it grew to 20,000 over a 30-year period. That 10,000 doubled in value over that 30 years, taking zero risk, just earning the interest that a treasury bill paid over those 30 years. Compared to the corporate bonds, some corporations go bankrupt within a 30-year period. There's some other considerations as to why they may or may not be more risky, but that's the major one. And so there is more risk, and you are compensated for taking on that risk. They have to pay you a higher yield for you to lend to them since it's more risky, right? And so over that 30-year period, your money grew to 60,000 roughly, versus the less risky, no risk T-bills, which only grew to 20,000. And then we see finally inflation is the green line. Inflation outpaced zero risk T-bills, right? So if you took no risk, you actually, if you adjust for inflation, you lost money over this 30-year period, right? Inflation or things got more expensive at a higher rate than your money grew. And that's what's called purchasing power risk. And we'll cover that in a moment here. So that's risk and return potential. And then compare, bringing that same idea or principle, I should say, to CalABLE, you can see on the left-hand side of this screen, I've put in the amount of bonds, stocks and bonds, right? And so we've already covered that bonds are less risky than stocks. And as you move down these different portfolios that are available to you, you can see as the risk increases, the expected long-term rate of return increases. And I've highlighted the ones that are comparable with the same inception date. They started at the same time, right? You can see conservative grew 4%, balanced, or about 7.25%, moderate growth, over 10.5%. And then comparing the ones that started in 2023, you can see it also works out as the risk increases, your expected long-term rate of return increases, very uniformly like that. And of course, in the short term, this may or may not be the case. I mean, you can see just last month, this is as of February, last month, the growth portfolio lost value. As we mentioned, stocks are volatile, whereas the income portfolio was the very best performing. And so in a month where the stock market declines, this won't be the case. The longer term you go, and we're looking at over 3 years here, it's going to prove true that you get especially historically, definitely historically proves true that you're well compensated for taking on the extra volatility of stocks. So and then I just want to briefly cover time horizon, which is the amount of time between you and your goals. And it doesn't necessarily mean your entire account has to have one time horizon. Maybe some portion of your money is for one goal and another portion is for another, and that's a great way to think about it, and that's fine. But as your time horizon increases, the duration of the investment that you have, your capacity for risk increases, right? So as we get over 3 years for our goal, let's say it's buying a house or retirement, it's more than 3 years away. We can think about taking our risk capacity has grown, and we can think about taking on more stock risk. And maybe we don't want to have as much bonds as we saw because they're less risky. Our expected return is going to be less. So that's risk capacity. The further away your goals are, the more capacity you have to take risk. Risk capacity is not risk tolerance, however. So, the stock market's very volatile. And if you're not interested in taking on that volatility, regardless of your risk capacity being very large, maybe your goal is very far away, you just have to understand that you should adjust your expectations for the return potential of your account accordingly. You're going to need to save more money for your long-term goals if you're not willing to take on more risk, right? And so as you're thinking about how you'd like to move your money within the options at CalABLE, just know that short-term goals should have very little stock exposure. You're going to want to, let me see if I can skip ahead you're going to want to be looking in this income conservative and maybe not even the income and growth portfolio for goals that are less than 3 years away. And for goals that are longer than 3 years away, looking at some of these over here further to the right. Getting into the actual risks associated with your bond funds, if some of you had, for instance, this conservative portfolio here in 2022, and you're thinking, why is this moving around so much? Because I thought this was in bonds and it shouldn't be moving around at all. We had a significant and sharp interest rate increases that year, and the interest rate risk associated with bond funds um, can cause these funds to lose value. Uh, Even though what you expected was you're just going to get your interest payment and then it will mature and you'll get your money back, right? That's how a bond works individually. But let me explain interest rate risk. Um, as interest rates increase, the value of existing bonds decrease, right? So I told you earlier there's a secondary market for bonds. They can be bought and sold before maturity. Someone who's going to buy your bond right now with in a higher interest rate environment than existed 3 or 4 years from now, they're not interested in that low interest rate on that bond. So the price of the bond comes down, which will give them a higher interest rate if they purchase it at that price, right? And so uh, and it cuts both ways. If interest rates come down, and they have come down a bit from a recent peak that they hit, as interest rates come down, bond prices move up. Existing bond prices increase, and your bond funds will gain value. And I'm sure many of you have seen that over the last 18 months. In aggregate, I mean, it's been bouncing around. So that's why your bond funds are moving around, is the interest rate risk. And the important thing to remember is within that bond fund, very little buying and selling is going on. It's a bond index fund. So these bonds are held to maturity. So the moving around doesn't change the amount that they're compensating the owners of that fund from the interest. And when the bond matures, that or principal amount that went into it is returned to the bondholders, right? So that happens regardless of the fluctuations in between. And then you have credit risk, and I think if we're looking at these are the options that you have within CalABLE. These are the investment options, and these are the actual funds that are used. So if you see the high yield corporate fund, that would be the fund that's subject to this other risk. That's credit risk. And I don't want to get too deep into this because it's a small portion of what CalABLE offers. I think, the most, it's only 6% at the most in any of these options. But companies that are, sorry, I skipped the wrong way. Companies that are um, more likely to not be able to make their payments before the maturity date have higher credit risk, and their bonds are going to yield whole lot more. So if you're looking at this and you go, wow, why are they only putting 6% of my money in high yield? That sounds really great. I like high yields. Well, it's because, like we've discussed, there's a relationship between risk and return, and these bonds carry a great deal more risk. They're also pretty highly correlated, or they move in sync with stocks when there's economic worries, or when we have a crisis, because a lot of these companies that have kind of a weaker financial picture are even more at risk, and a lot of them ultimately do end up going bankrupt and not being able to return the principal to their bondholders. So a lot more risk there. And we covered purchasing power risk. That's not keeping up with inflation, right? You need to make an adequate return, or else you will lose your buying power over time, right? And so again, I'm just going to take a moment on this screen here. This is all of your bond funds that you have and the risks that are associated with them. Just one thing to note is, there's significant risks for all of these, but the one that has moderate risk, which is just moderate interest rate risk, is the one that you'll see. Oh, I think I paused my screen share here. Okay, sorry. Sorry about that. So the one that you'll see is most prevalent throughout all of these investment options is the US bond index fund, right? Throughout all of these options that actually carry any bonds whatsoever, that's most highly used, and it has some sensitivity to moves in interest rates, but aside from that, it's not highly risky like some of these other bond funds can be, emerging markets, high yields. So we can keep moving here. All right, so risks associated with stock funds. And this is a busy chart, but basically what this chart says is versus buying an individual stock, a stock fund has much less risk, right? There's two types of risk when you're talking about stocks. There's systematic risk, which is market risk, and there's unsystematic risk, which is firm-specific risk. So when you buy a bond fund like the ones that are available with CalABLE, you are eliminating firm-specific risk, all but eliminating it. That's what this red line represents. All of this risk that's in here, this is total stock risk. All of this risk is eliminated, and what remains is market risk, right? And so when we're looking at the major risks associated with stocks, we can cross this out. We don't have to worry about this with CalABLE. We don't have firm-specific risk. It's diversified away from the use of funds. But we are subject to headline risk, interest rate risks. These companies, when rates rise, these companies, for a variety of reasons, become less valuable. And one of them is that they now must go borrow and refinance their existing debt at higher rates. And another one is I mentioned this briefly at the beginning. A company is worth the amount of cash flow it produces over the coming 5 to 10 years, discounted back to today. Well, that discount rate, when it increases, companies inherently become more valuable, or sorry, less valuable, right? And so we saw some of that also a few years ago when interest rates started to increase. The market took a pretty good hit as well. And of course, this is mostly the emerging markets fund that's available to you, and it had a lot of geopolitical risk there, less political stability in some of these emerging markets, and then headline risk. I don't, the example of the current market, we've had a little bit of a decline year to date. Is there's a lot of news and uncertainty regarding tariffs, right? And so that would be a really good current example of headline risk and how that it can affect markets. And so these are your investment options. Um, as far as stocks goes with CalABLE, and again, most of your exposure will be this total market index fund with less in these foreign markets, developed and emerging foreign markets. And this total market index fund is all of the public U.S. public companies, and it's market cap weighted, meaning larger companies make up a greater share of the total fund. It's based on the size of the company, right? So you'll have companies like Apple and Google will make up a much larger percentage than a smaller company. Like a Dutch Bros or something smaller would still be present in this fund, but less of your money would be in that. Um, and then I know this is a very busy chart in front of you, but this is just a good example of market volatility throughout the years. This is 44 years of the U.S. stock markets calendar returns from January to December 31st. And so that's the gray bars, right? Each year, 33 of these 44 years were positive returns for US stocks. But if you look at the red dots, those represent the largest intra-year drop in that given year. Okay, and so this is the bottom here. Sorry, it's a little obscured. Is each individual year over those 44 years, and I think probably a recent example that rings very true as to how volatile things can be. In 2020, in March of 2020, we had shutdowns due to a pandemic. The market declined. Let's use an example here of $100,000 portfolio. Your max amount for your CalABLE contributions. $100,000 went in 2020. 16 by March, when shutdowns were announced, the market had declined 34%, right? You now had 66% or 66,000 left of your 100,000. You could be pretty upset by that and maybe think, I'm tired of losing money, and think it might be a good idea to give up on that and try something more conservative. By the end of the year, by December 31st of that same year in 2020, the market had increased, the US stock market had increased by 16%, including that 34% drop, right? So your money went from 100,000 down to 66,000 and it ended the year worth 116,000. So that is an incredibly volatile year, right? That's an extreme example, but it does happen quite often. And despite that, despite average annual intra-year drops of 14%, 33 out of 44 years you have a positive return. And we've saw from the very beginning chart that you've been very well compensated for taking on the volatility of stocks. Let's see if I can. All right. And then another busy chart, sorry, but investing is counterintuitive. So you see this is the consumer sentiment index that's tracked by this gray line that's swerving all through the screen here. And so this is just a poll that's taken of US consumers, how they feel about the economy, right? And so the average is this dotted blue line. They feel it's about, 85 here. And then you can see it peaks in the around a 100 range to 110 is when consumers are feeling really good about the economy. Now, down here in the 60s and 70s and 50s is when the consumers are really feeling like the economy is not going to do well. The blue dots represent the subsequent 12-month returns from these peaks and valleys, right? And so that's in the following 12 months, how much money did this US stock market return? Well, when people were feeling really good about the economy, it returned generally not very much, right? -6, 1.2. There was one kind of you know, example of a good return, but most of these are not very good. And that's because of what I said in the beginning. A stock is worth the expectation of future cash flows. So when people expect corporations to be able to generate a lot of cash flow, they pay a lot for those stocks, right? The stocks become expensive, right? Conversely, let's look at when consumers feel really poorly about the stock market. Plus 22% in the subsequent 12 years. I can't see that one, but 29%, 32, 22, 15, you can see they're all very high positive. There's no example here of it not being a very high positive annual return following troughs in consumer sentiment. And by the way, these gray bars represent recessions, right? And so typically sentiment is at its lowest, right? When we're pretty much already out of the recession, right? That's the end of it, right? And sentiment is low. People are saying things are really bad. Well, you can imagine they're not paying a whole lot for stocks. So their expectations for the profits they generate is very low. Their prices are low because that's how stocks are valued and subsequent returns are high, right? So it's counterintuitive. So when you're in the depths of a recession and you're thinking, I'm tired of my money going down every day, it's just going to get worse next week. Remember, that's probably, or at least we can say definitely historically, without any doubts, historically, that's when it would have been a better time to buy more stocks and not sell your stocks, right? So it's counterintuitive there. And then finally, this is an old example. This is from Capital Group. They're a mutual fund company, and their mutual fund ICA is large cap stocks, which is somewhat similar to the U.S. stock option that you have with CalABLE. Um, the point that this makes, they call this guy Louis the loser. That's not very nice. I think Louis the unlucky maybe would be a nicer way to go. But Louis puts in $10,000 every single year for 20 years straight on the worst possible day, the very top of the market before it declines in each given year for 20 years. So he in total puts in $200,000. At the end of that 20 years, even though he had the worst possible timing you could possibly have, his money grew to 495,000 or over an 8% annual return, right? And so Louis still did pretty well. And that's because Louis never sold. He didn't try to time the market. That's what this says at the top. Time, not timing, is what matters. He never tried to time the market. Uh, Over the long term, he just timed it within each individual year, but he left his money invested, right? So it's time, not timing that matters. Let's see what happened. What would have happened if Louis had the best possible day, right? Or he invested his money at the market low in each given year for 20 years. So the best possible timing each year. 200,000 went in over those 20 years, $633,000 versus that 495 or a 10.4% average annual return, meaningfully better, right? Both are great. Time, not timing, is what matters. The reality is no one is actually going to be able to pull this off. You know, not even the luckiest person is going to be able to pick every single worst or best day. We're all going to end up somewhere in between this. If we're putting a little bit of money into our CalABLE account every year, what's important is that we're not trying to jump in and out of the market, that we stay invested, and that is what produces results, right? And so that's the final slide I have for you, and hopefully that was useful and helpful for everyone.
Thank you, Jessie. I think we had a lot of questions here. One quick question. Is there a book that you can recommend? I know there are a lot of charts and things, but I think some of our listeners here would just, also like if there's a book or resource that maybe you could recommend to them. If you want.
You know, a lot of the books that I really love are more about investing in individual stocks and bonds, which is what I do a lot of. And so I would like to get back on that question and come and find a good recommendation so that I can, because there's a lot of books that I love that probably wouldn't, be necessarily what I presented today. So, but I would like to answer that and follow up with that on that one.
Maybe you'll have something by the end.
Yeah.
David, you're up. David is from Vestwell. They are our partners, and he's got some slides he wants to share with us today.
Hello, everybody. My name is David Bell. Just for those, I am a white male, middle-aged, brown hair, and I'm wearing a textured collared shirt. I also probably should tell people that I am currently at an airport. So if I'm in Washington, D.C., flying back to where I live. So there might be some background noise, and I'm really sorry about that, but I wanted to spend some time with you all today. My role at Vestwell is to head up all of our ABLE savings programs and also our education savings programs. Some of you know the 529 savings programs. But today we're here talking about the ABLE savings program and specifically CalABLE. There was a lot of great information that Jessie shared. I know that some people in the question and answer section were mentioning that this is very confusing, and it is. Thank goodness we have professionals like Jessie who have to really focus on all the detail here. I can tell you that we also have professionals that not only work for Vestwell, there are professionals that work for the CalABLE board and many others that have all this information and have taken all this information into account when we built out much more simplified options for you to save and invest in. So when you go to the website for CalABLE, you can see some of the funds that Jessie was mentioning. And it's really good that you have the background information to know maybe what the difference of a bond fund or a stock, et cetera, mutual fund. Really, it's important for you to know that a lot of people spent time designing these so that you can pick ones that best fit you. And on that website, CalABLE website, you'll see a little brief description of why you may want to choose this fund if it fits your personality or your place in life. So we're excited to be able to provide that to you, even knowing that there's a lot more detailed information behind all of these. So please rest assured, I teach personal finance, money management at a local university. And it's just confusing for everybody. I've said it many times, it's confusing for me, but it's important to know that we should take it seriously. I should probably start with my portion of the presentation. So thank you so much, Jessie. And thank you, Anne. I'm going to talk a little bit about your CalABLE account specifically, and about the account management that you can do with the program. So the CalABLE team asked me to touch on a few specific things. So if we can go to the next slide, I'll highlight those now. So our agenda, as we want to call it for this small portion of the presentation, is basically you then being able to manage your account the way that you need to. And so the four things that they asked me to cover, although there's many more things that you can do with your CalABLE account through your online portal, your savings kind of login, or by calling the call center. But the four things that they want us to talk about is changing your savings options if you want to make a change, and I'm going to talk you through a couple options there. How to take money out of your account, and I'll provide you some options there as well. How to order a CalABLE prepaid card. It's a great thing to use. You don't have to, but if you want to use that as a way to spend your money, I'll explain that. And then how to plan for emergency expenses. So these are the four things. Let's dive right in if this is okay. So let's first talk about changing your savings options. The first thing I need you to understand, and this is pretty important, is there's a difference between adding new money to your account in a different savings option versus moving some of the money that's already in your CalABLE account to a different savings option. Those are two very different things. Let's talk about the new money, meaning it's not money you've put into the account yet. Any new money that you're putting into your CalABLE account, anytime you choose to do that, you can choose any savings option you want from the menu. It can be a brand new option. You can do that as many times as you like. Most people are just choosing to save in one or two places, but there's 8 options. If you wanted, you could save money in all 8 options. I'm not saying that's a good idea. It's just you have that ability. There's no restrictions. If you truly are interested in moving money that's already in your CalABLE account from one savings option to another one, there is a restriction. You're only allowed to do that 2 times per calendar year. So you could do that in January, you could do it again in July, but then you'd have to wait until the next January before you did this again. It's a strange restriction. It's part of the federal legislation, and I'm sorry. There are people that are trying to change that to give you more options. But right now, tied to the federal legislation, you can only choose to move existing money. We call it exchanges. You can only do that 2 times per calendar year. Let's go to the next slide if it's okay. I'm going to talk about where to find this information in your account. So all of you that have a CalABLE account have the ability to log into your dashboard or the place where you manage your money. This is a snapshot of a sample dashboard I took. And if you see, there's a couple of different options at the very top. There's overview, which you're looking at here. I'm very sorry that this is small. I wanted to show you the whole thing. You see activity, which is just to the right of that. It's at the top. You see investments. You see transfers. And then you see settings. Each of those you can click on and see all the options below. If you want to put new money into your account, you would click the transfers button, and then there would be a drop down, and it talks about contributing money to your account. I'll go into a little bit more detail about that in just a minute. If you want to do the second option, where you're moving money from one savings option inside CalABLE to another, and you can only do that 2 times per calendar year, you'd actually click on investments, and then you would select the exchange option, and it'll walk you through. In fact, let me go to the next slide. So if you were to click on the new money, you wanted a new contribution, and so you went over to transfers and contributions, you would get to something that eventually kind of looks like this. It allows you to choose how much money you want to put in whatever savings option you want. Pretty simple. You might want to just put $25 in one option. Maybe you want to put $25 in one and another $25 in another. And then you follow the instructions and it puts it in there. Very simple, very easy. And that would be moving money from your bank account or your credit union account that you have tied to your CalABLE account, and it would put it into your CalABLE. If you wanted to do the other one, which is change your actual investment, exchange it, let's go to the next slide. you would actually click on that option that said exchange under the investments. I know I've already explained where that is. If you click on that, there's just two simple steps. One step is this. This is just an example. It may not look exactly like this, but it might give you some warnings on what you can do and can't do. It might tell you if you've already done it one time this year. In this case, you hadn't. So you have two exchanges left for the year. And you first start with step one. You just tell them which investment option you want to move the money from. So, where is the money now? You select which one, how much you want to move. And the next step, which I don't have a screenshot of, the next step would just be where you want to put your money. It's as simple as that. It really just walks you through that very simply. So, although both of those options are simple, I just wanted to explain that there's a difference between putting new money in, which you can do anytime, anywhere, or if you want to move existing money. Let's go to the next part. This is the second thing that the CalABLE team wanted us to discuss. How do you take money out of your CalABLE account? This is important. We want you to put money in and we want you to have access to your money, and this is really important. So there's four main ways that you can take money out of your CalABLE account. You can move money from your CalABLE account electronically to your bank account or your credit union account, whatever you have linked to your account. You can move that by doing a withdrawal to your bank or your credit union. It's simple, it's easy, and I'll go over the timing of this on the next slide. You can also send a check to yourself, the account owner, or if you're an authorized legal representative, somebody who is supporting and helping managing the account, you can have the check sent to you. Not many people do this because it's kind of slow, but you can do it if you want. You can also send a check to a third party. This might be good if you're paying rent. So you can have a check sent for $100, whatever your rent is. It might be more in certain parts of California, probably is, directly to your landlord if you want. And by doing that on the portal right here, you can kind of see that as the third bubble below. It'll ask you for some information that you fill out, and it sends a check off to that individual. Very, very helpful. And you can also set it up to where it does it on a regular basis. Maybe you want a check sent every month. So the system can help. The last thing you can do, which a lot of people do, they can move money from their CalABLE account onto their CalABLE prepaid card, which is a great option. I think if we could go to the next slide. Sorry, I'm going to talk a little bit more about the CalABLE prepaid card in a minute. This is actually going to talk about, we can stay on that next slide, please. This is a important piece that combines information that's helpful for you to know. When many people don't realize that CalABLE account, even though it looks and it feels very much like your bank or your credit union, the way that you're saving your money is just a little bit more complex than that, as you all know from the presentation from Jessie. The money, when you move money, withdraw it out of your CalABLE account, whether it is electronically to your bank or maybe onto the prepaid card, it's going to take about 2 days. It could even be maybe an extra day. I just want to warn you. And if you're sending a check, you have to wait for the mail to get there. So that might take a little extra time. So this is important. We have warnings in our system and on our website that tell you this might take a couple of days. But I wanted to explain why. Why is it taking a couple of days? Well, the same day that you ask for the money to be withdrawn from your account, we start that process immediately. We will, as you can see on day zero is the day you're starting the process. You're asking for the redemption. That means you're asking for the withdrawal. And we are processing it that same day. You can see that the next bubble over, which is still day zero, Vestwell, which is the program manager, it's the partner of CalABLE that does the money movement, will initially, as long as we get that information before the stock market closes, we will initiate that process on the very same day. If we get that after the stock market closes at 4 p.m. Eastern time, we'll still put in the trade. It just won't happen until the next morning. On day one, which means the next day after you asked for the contribution, the withdrawal, excuse me, that's when all of those trades will settle. And when I mean trades, it just basically means you're moving money out of those savings from CalABLE, out of kind of all of those savings that Jessie talked to us about, and sends it over to your bank or to the prepaid card. And then that's the time when second day after you made the request, that's when it actually makes it onto your prepaid card or into your bank, as long as your bank is following that same kind of fast process. So I'm really sorry that it can't be done instantaneously. We're looking for ways to make this faster, but we have to follow the same rules and regulations of the financial industry this way. I know that when I move money from my checking account to my savings account at my credit union, it happens immediately, but that's because both accounts are at the same institution. When you're moving it from one institution to another, it takes a little more time. So let's go to the next slide. Okay, how to order a prepaid card. This doesn't happen automatically. You do actually have to request it. There's no cost to you, but we don't want to send people prepaid cards if you don't want to use them. But it's simple. We do use another company for our prepaid card. They're an incredible company called TrueLink. They actually are in California, and they were created specifically to support people with disabilities and aging adults, older adults that might need some extra help. To order your CalABLE prepaid card, you log into your same dashboard that we showed you originally. And one of the main tiles that are on your dashboard talks about the prepaid card. It gives you more information about it, and it also lets you order the card. So you click on that link and you'll immediately be connected with TrueLink to fill out a little bit of extra more information about who's going to have the card. Is it the account owner, the person with the disability, or is it the authorized legal representative, or both? You both can get a card. Who's it for? And a little bit more information, and they will send you a prepaid card. Could we go to the next slide? These prepaid cards are amazing. Basically, you can use these prepaid cards anywhere that Visa cards are accepted, which is almost anywhere, online, at stores, what have you. It's really easy to control your spending. I'm going to talk about that on the next slide. You can load up to $20,000 on the card. It might not be a good idea to put that much money on there unless you really needed it for something. You might just want to put a few $100s on. It's your choice. But I just want to make sure if you put money on that card, it's available to be used. But there's other spending controls that you can put on the card if you want. If you're an account owner and you want to kind of put some level controls on yourself, which basically means it limits places where you could use it or how much you can spend, you can do that, but you don't have to. The authorized legal representative can do that as well to limit the amount of places that the accountant can spend the money. Let's go to the next slide. This is just a snapshot. And again, I'm sorry it's really small, but when you're in the portal, the savings portal, you can adjust where you spend money at the prepaid card and where not. A good example might be a Target store. I might know that I love going to Target and sometimes I spend too much money there. So I could put a limit to where I can only spend $50 anytime I go to Target each time. I could turn off certain things. Hey, I don't want to spend any money at a certain restaurant or a liquor store or something, or you can leave that open. You can move those yourself. We don't do that. It's just for you, but it's an incredible tool. Let's go to the next slide, please. Okay, so how to plan for emergency expenses. This is important. If you remember, when you take money out of your CalABLE account, it does could take more than that days. You want to make sure that you're ready if there is an emergency. I don't have perfect answers for you. These are just ideas, so I don't want to say you have to do this. But if you're interested in having access to money immediately in an emergency, you may want to follow one of these scenarios. The first one on the far left, the light blue box, you can take money out of your CalABLE account. Like I said before, it can go to your bank, a check can be sent, you can move money to your prepaid card. Please do remember that that can take 2 or 3 days. Let's say, just in case, sometimes emergencies can't wait that long. So it's available, but please know that it can't. Let's actually look one over to the blue, the middle, the dark blue. Oh, I'm so sorry. The dark blue box. There are many people that will keep some money on their prepaid card in case of an emergency. For instance, they might want to keep $500 on their prepaid card at any time. This is just an example. Please, you fit it to your needs. But that way, $500 is always available as long as they can spend it at a place Visa is accepted. You might need new tires for a vehicle that you rely on. You might need to take an emergency trip on the bus to go visit somebody. These are interesting examples. I'm just making them off the top of my head. But having money on your prepaid card, that means you can use it immediately. And then when you use some of that, you can top it back up if you want. An important piece is that last bullet point at the bottom of the dark blue. If you move money from your CalABLE account to your CalABLE prepaid card, it's officially outside of ABLE, but the money is protected against asset limits, even as if it was still in ABLE, your CalABLE, as long as you intend to use it for qualified disability expenses. That's what QDE stands for. I just didn't have room to write that. So you could actually keep that money on your prepaid card for month after month and not use it, as long as you still plan on using it for qualified expenses. If it is for housing expenses, you're supposed to use it the same month that Social Security Administration has asked us to say. Let's look at the very last bubble, another option. And many of you know this already, but as you know, you can save up to $2,000 of assets in outside of ABLE before it starts affecting some of your key benefits like supplemental security income, SSI, or there's other benefits that it might affect if you save too much money. You may want to save a small amount in your bank account if you don't want a prepaid card. Maybe you always try to keep $500 or $600, $700. It's up to you, whatever amount you want to save, as long as you're staying below that $2,000. That might be a good option, because then you can use your debit card or go to the bank if you do have an emergency. Again, these are not perfect options. They're not going to work great for everybody, but I wanted you to know about these options that might help you in case you need really quick access to them. I think we can go to the last slide, which is really just a thank you. And there's going to be some new features, I believe. I'm not sure if I'm speaking to this or not. Anne, is this for you to speak about? I'm so sorry.
I can speak to it, David, but thank you so much. So there are some new enhancements that we are going to be discussing today. The first thing is the gift page enhancement. This page now allows for reoccurring gifts. So if your family members, if they want to create profiles, they can do it, and they can set up a reoccurring contribution. It only takes a few minutes. So let's say you're a college student, and we always know college students always are asking for money. You might want to just put $20 in that account every month. And so, that'd be something very simple that you can do. We'll go to the next slide. Also, I just want to remind people that you can do direct deposit with your Social Security check that can go in. And then you can also do reoccurring contributions and you can set those up. So David, I did have a quick question. Somebody wanted to know if they can do this online now instead of having to go to the call center.
Yes. So are you talking about the recurring gifting, Anne, or are you talking about the direct deposits?
Reoccurring contributions. So if they want, to just do that, can they do that every month and not have to have the call center do that? Can they do it in the portal?
You can do that right in the portal, and you can do it every month, twice a month, once a year. I mean, you can set it up in many different ways, and you can do it right there in your online portal. And it'll be a question that's asked if you're making a contribution, whether you want to do it one time or recurring, right in the portal.
Okay, great, thanks. We'll go to the next slide. Also want to remind everyone that the app is available on your phone. It's available for an Android and an Apple iPhone. It shows best well, but hopefully that is going to be changing to CalABLE, but right now it does show as Vestel on your phone. We'll go to the next slide. This is really exciting. We just got 10 different languages available on our website, and this is exactly what the home screen looks like. So if you need one of these explanations in one of these languages, we do have it. So just want to let everyone know that that has just been launched. We'll go to the next slide. Just a few reminders. Next slide. We did a webinar on taxes last month, so you should be receiving the 1099 QA form for distributions and the 5498 QA form for contributions. If you want to know how to use these for your CalABLE account when you're filing your taxes, I would recommend looking at that webinar. I know we're short on time, so we'll keep going. Again, if you have any questions, you can always call our call center at 833 CalABLE, and that is between Monday through Friday, 6 a.m. to 5 p.m. We'll go to the next slide. We just did a contest here at CalABLE. We asked, the title of it was Express Yourself Winner. So we're going to show you some of the winners. The contest still is going on through the end of this month. And if your artwork is selected, you will receive $200. So let's see some of our winners so far. Next slide. Okay. I was practicing this name. Rogelio is one of our winners. Vanessa is one of our winners. We have Hugh and Cynthia, Casey and Brianna, and Ryan and Eleanor. And if you had a chance to see us at Abilities Expo, we actually did have these all printed on some cards for people. So check out the artwork. It's really exciting. And again, you can still submit through the end of this month. And if you are selected, you will receive $200 in your account. We'll go next slide. We do have a lot of resources. We have our partner toolkit. Really encourage you to visit our YouTube channel. We had that up earlier in the chat. That's where all our webinars are housed. We have quite an extensive library. I did mention the one we just did on taxes. Really encourage you to view that. For anybody who's new, we have a CalABLE Basics webinar. That one we did in January. And next month, we will be doing one on qualified disability expenses. So always have lots of questions on those. So we will be having that topic next month. We'll go to the next slide. We will be having Maria. She will be doing ABLE 101 in Spanish. We always like to have an update of that every year. This is just so everyone is informed of what all the new changes are, and she will be doing that exclusively in Spanish. We'll go to the next one. We do have a webinar survey that we ask that everyone complete. If there's a question that we weren't able to answer today, if you include it in the survey, we'll be sure to get back to you on that. So this is your opportunity to tell us how we did. I know we had a lot of returning account holders today, people attending. So if there are topics that we haven't addressed that you would like us to discuss, certainly let us know. Again, these webinars are for you, and so we want them to be as informative as possible. We'll go to the next slide. Again, we talked about this earlier in the presentation, but just a reminder that this material has been prepared for informational purposes only and is not intended to provide and shall not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Next slide. This is our disclosure. There you go. Thank you. Jessie did have an author, had a book. I know that was one of the questions. Jessie, do you want to just share that with everyone? We can put this in the chat as well.
Yeah. Yes, I did find a book that I think is good. I mean, all of the underlying investments are index funds, and I didn't explain, exactly what that means because that's all that is offered anyway. So, but because it's that's what's offered, I found a book that's called How to Invest in Index Funds: Step-by-Step Comprehensive Blueprint on How to Invest in Index Funds Easily for Complete Beginners by Michael Thompson. So that's I think will give you a better understanding of the investments that are offered inside the CalABLE account.
Thank you, Jessie. David, we had a really good question here. It says, for 2 moves per year, is that a single move from one account to another, or can you make multiple moves in a single day?
And I do believe David had to drop off.
Oh, I'm sorry. Okay. Thomas, Thomas is gone too. I'm going to have to get back to you on that one. I don't want to answer this incorrectly. I do know we had talked about Eastern time and what is that, and I just wanted to say in Pacific time that is 1 p.m. So if you are wanting to make any of those withdrawals from your account, you'll want to make sure that you do those before 1 o'clock our time here in California. Sometimes I know Eastern time can get a little confusing for people. So if you want that to start on day 0, as we saw in the example, we want to make sure you start that before 1 p.m. If it's after 1 p.m., it would be processed on day 1 as soon as the market opens. So just to clarify that.
And I think we can answer this question. The question is, I understand that the money put on the prepaid card has to be spent in the same month you put the money on it. If it's for housing expenses, what specifically are considered housing expenses?
Housing expenses, and when I think about housing expenses, I think about your rent, like a water bill, a utility bill. If you have insurance, some people have renter's insurance that they're paying. I saw the question about a cell phone and streaming services. I would not consider those housing expenses. Those would be just regular items that you spend. But it really is, if you think about what is inside that house, it's the dwelling that you live in, and then what goes on to maintain that house. So your utility, any of those items, and insurance So those are what I would consider housing related expenses.
Okay. And then we don't have too much time yet, but there's another question here. Is there a maximum I can withdraw at one time, or can I withdraw my entire account at once?
I believe
There are some limits for the prepaid card. I believe if you want to withdraw your entire account at once, you should request a check. Yeah, I think those are the parameters on that. You could, I think an individual can withdraw the entire amount of on their CalABLE account. I want to make something clear, and I have this question. We had this question earlier too. If someone, for example, wants to withdraw $20,000 from their CalABLE account, they are not going to be able to put that amount of money on the same year. They will have to wait until the following calendar year in order to make another contribution. This is if that person already contributed, for example, for 2025, 19,000. And then let's say someone, I don't know, it has a goal of purchasing a car, for example, or a van or something like that. And they decided to withdraw the money. And then let's say they couldn't make the purchase or something happened and they want to put that money back and they already contributed 19,000, let's say for this year, they will not be able to put that money back in their account.
that's correct. Yes, so it's total contributions in a calendar year, and the total contributions for this year, 2025, is 19,000. So Maria was absolutely correct in explaining that, and thank you. I did see that question come through. Is there anything else?
Hi, I actually see a question for Jessie, which is, can we become clients of Jessie Nix?
Yeah, yeah, absolutely. Yeah, we like I said, we work with individuals and families. So pretty much everyone who has investment goals. We do our clients. We have a $100,000 minimum to get started with us investing, but we absolutely will work with anyone in the U.S. We have clients across the country. So yeah, it's a good question. Thank you.
Oh, yes. Somebody wants to take a trip. Yes, travel is an allowable expense. Again, love this question. We always get this question. And I asked the person asking is this trip going to improve your health, your independence, and quality of life? And the answer yes to one of those items, then yes. And it certainly does improve my mental health every time I go on a vacation. Just getting away certainly just helps me to reset. So I would say yes to the vacation question here. Yes, okay. We are close. We are at time, so I want to thank everyone for being on this webinar today. This was something new that we had a lot of questions about financial planning, and so I want to thank Jessie for coming on. I'm sure he gave us a lot of information, maybe a little too much that we were ready for, but I think it was really helpful. And again, this will be available in replay. So if you guys if anybody wants to review it again, it certainly will be available. I want to thank our ASL interpreters today, thank our captioner, and also thank our Spanish translator, Aldo. So thank you so much. I hope everyone has a wonderful day. And also, we did change the time of this. We normally do our webinars at 2 o'clock. We changed it today at 1 o'clock. Let us know if this is a better time for you. Again, we want to be available to you at the right time. So let us know if this was a better time than our 2 o'clock. If you want to let us know in the surveys, that would be great also. And thank you, everyone, and have a wonderful day.